Moving on, why should investor consider your trust right now? And we've already talked about maybe rates coming down, but what's going to be the catalyst that we think is going to turn this, what is a great prospect around in terms of getting investors in? And I'd like to start off with Ben, please.
We have a very specialist product, and the reason to invest in this sector specialist trust is because we offer exposure to the digital economy, to the plumbing of the digital economy, for which we seem to have an insatiable demand. This video conference would not have been able to take place not even a decade ago. We use systems such as Teams. The amount of data that is sent back and forth for entertainment purposes and for business purposes is absolutely staggering, and governments are belatedly beginning to digitize to seek some forms of efficiency. Taken together, this is a multi-year trend, and if you'd like, precise exposure to it, that's what we offer. I think there are some additional things that can potentially help. Ending fee disclosure. I know I hammer on about this, but it's such an important issue. Ending the inappropriate fee disclosure rules would help, as would the government creating a framework for more pension capital to flow into listed alternatives. This is an ideal solution for both defined benefit and defined contribution plans. And should that happen, it would provide a flood of liquidity that could help all of these trusts close the valuation gaps and potentially even return to the heady days of trading at a premium.
Absolutely, revitalising London stock market and getting those pension investors in is very important. Now, Jean-Hugues, what about you? What do you think? Why is your trust attractive right now for investors?
We believe it's attractive mostly because of the fundamental outlook that I just described, but also because our investment universe is trading on its historic lows in terms of relative valuation. When you look at relative PEs, and again in the context of accelerating earnings growth, you're very much trading on multiples which make little sense, and very much dismantled, again, by the context of rising interest rates and inflation over the past 3 years. So this derating that we've seen of the space, in our view, is actually an opportunity to acquire high quality assets with very solid outlook on the cheap. And those who have identified this opportunity seems to be the private equity operators, who are currently finding very attractive, kind of acquisition opportunities in listed infrastructure at actually significant discount to the valuation levels that they are ready to pay. And considering the massive amount of cash that the large private infrastructure specialists have raised over the past few years, this, in our view, can only bode well for listed valuations going forward. I would add a last point is that EGL, so Ecofin Global Utilities Investment Trust, currently trades at a discount, 10 to 12%, more or less at the moment, while it was trading at a premium until kind of mid-2023. Again, it's derated in line with a lot of the infrastructure assets, but we believe for unjustified reasons to a large extent. So this is a double opportunity to buy those assets on the cheap, we think.
Yeah, well, it's really interesting that private equity is identifying the opportunity, but the investors aren't. They really need to wake up to this. Phil, how about you? What do you think could turn this around? Why should people be buying your trust?
So I think in terms of reasons to look at GCP infrastructure investments now, so GCP Infra IPO'd back in 2010. It's got a 14-year track record of paying a stable, sustainable, attractive level of dividend. And where we sit today, we have a portfolio of assets of around £1 billion that's well diversified across multiple sectors, so renewables, PFI, PPP, and social housing. 99% of the portfolio is operational, so it's a mature and diverse portfolio with a long track record of delivering an attractive income that today you can access at around a 10% dividend yield on where the share price is trading. And I echo John Hughes's comments that we find ourselves at a discount in terms of share price to NAV that's pretty unprecedented for the majority of the fund's life. We've traded at a premium to NAV, and that means the discount that investors can access the shares at today provides that really attractive income on a mature, diverse portfolio. I think look into the catalysts, and I guess I see GCP Infra as an attractive investment in its own right. If you layer on top, I think, some of the catalysts for a re-rating, as we started off the conversation, I think policy is aligning with the need for new infrastructure, and I think that will create many exciting investment opportunities for companies like GCP Infrastructure. I think the policy environment around interest rates will certainly help. I'd also agree with Ben's comments that there is a UK liquidity market failing that's been part of the challenge we've had, whether that's cost disclosure or lack of investors outside of wealth managers, multi-asset managers participating in the investment trust space that we also need to address. I think we have to work hard to sell the benefits of investment companies as a way of accessing attractive, diversified, specific asset classes for investors as part of a diversified portfolio. So I think we'll continue to do that work. I guess today is part of that long journey, but also I think regulation needs to address the liquidity market failing that's happened.